Oh, okay, let's continue. We have the trade, the pullbacks. This is what I said a while ago that once the market, you determine that the market is really going down, expect for the pullbacks. There will be always pullbacks whenever the market goes in one direction. Example, it's going to go up. There's going to be a pullback. You can place your trade in the pullback, then let it go up again. Or maybe downtrend. There's a pullback for the downtrend. So whenever it goes up, then you place your trade and then it goes down again. So you can trade a pullback that is consistent with the following the trend. Because you go with the trend, you're not against the trend. Okay? So you trade the pullback. Another approach is watch the pin bars. So whenever you trade, you have to look for the pin bars and other different candle formations. Example, we have here the bearish pin bar. We have the bearish pin bar and it's really going to go down. Here we have the piercing candle, piercing, okay? Then it's really going to go down. Then we have here the pin bar. It's really going to go down. However, it went up again. Actually, you can place your trade here. This is a pullback, okay? So you can trade the pin bars. Ito, trade this one. You can trade the pin bar here. You can sell here. Here you can sell here because there's a pin bar. Okay, that's consistent with the trend. Next is watch MA rejection. If there are rejection example, this one was rejected here. It cannot go down further. Further, it was being pushed up, and then it really went up. Went up. Okay, there's a pushing up. There's a buying pressure pushing up. Okay, so it was rejected from the moving average as a support. Okay, so it went farther from the moving average. That's it. It floated above the moving average. In other words, it's going to go up. It's really going to go up. Here, it touches the moving average. Little by little, it went up. Here, it went up. Then it went down again. Then it went up further until it's really, really very far away from the moving average, which serve as a support. Okay, so watch for the rejections. Okay, another is watch key levels. There are key levels here. Here there's a key level. Here there's a key level. Lots of resistances here. Resistances here. It serves as support. Here it serves as support. Also we have the key level here. Serve as support. And here we have the resistance. Serve as a resistance. So you can place your trade on the key near the key level. But again, there's a psychology for that. Whenever you place your trade in the key level, you must avoid putting a stop loss near the key level because the banks knew that near the key level, that's where the losses are. It's concentrated. So lots of retail traders are going to lose their money because the banks, what they're going to do, they need your money. They need liquidity. They have to get your money. They have to get your money first through the stop loss hunting before it can go to the direction you want where the market will go. Okay, so here we have the buy. You buy. I buy here because of the impulse. Very long candle impulse. Now you can actually buy here because there is a rejection from the moving average. And also we have the pin bar here, and then we also have the bullish engulfing after this small bearish candle, then the bullish followed by a pin bar. Then we have here the moving average, rejection from the moving average. So there are many signals. We have the key level, we have the rejection from the moving average, we have the pin bar, we have the pin bar here, and we have the bullish engulfing. And I'm very sure that it's really going to go up. That's why I put my trade here. Actually, I can put my trade here. But I found this to be very late in my cell phone. So I traded late. I found this late. So that's why I put my trade here. Nevertheless, I'm not actually late because I still made money from here to here. And this one serves now as your key level. Okay, key level. Probably the market will go down because of the key levels here. Yeah, that's the key level. It's going to reverse. Anyway, considering that this is a very long candle, probably it's going to break this area. It's going to go up because here we have very two long candles. So probably it's going to go up. Anyway, I cannot remember whether this really went up or really went down. Nevertheless, the idea of trading is very simple. You have four confirmation. Confirmation key level. We have the pin bar. We have the pin bar here. We have the bullish engulfing. A bullish engulfing. This one bullish engulfing. Small followed by a long candle. Then we have the pin bar rejected from the moving average. So that's why you can confidently place your trade that it's really going to go up. Okay. So next we have plan your exit points. Now, so I'm buying here, then my exit point probably will be here. Okay, and also here actually I can close, but I put another trade here because the bar here is very low. We have here the candle is very low, so I was confident that it's really going to go up. So I added another trade buy here. Okay, so the lot size is 0.05 and 0.01. This is a micro lot. This is a micro lot. Then we have the pin bar here. It's really going to go up after the pin bar. Very long candle. So exit point probably I'm going to take profit here or probably here. I'm going to take profit because of the history. There is a historical resistance. And also here we have the resistance, historical resistance here, the past resistance. So I can close here. However, if you're going to maximize your profit, one of the rules of trend following is don't put a target profit. Just let it go. Let it go up or go down further. These are impulse, very long candles. Impulse, these are impulse. Okay? So these are corrections, very small corrections. Okay, so with the correction, we have here the pin bar. So that's all for the trend following. So I hope that you learned something about the trend following. So inside the trend following, we have the use of the moving average 8 and 12 and 8 12. We have the trade the pullback. We have the confluence trading, and then we also have the rejection from the key level. Those are really consistent with the trend following strategy. They are consistent with the trend following strategy. The best tip for you is before you're going to place your trade on trend following, you have to look at the different time frames. Example. Okay, so different time frames. We have D1. Okay, then we have M15. Okay, we have the H1. So look at the different time frame. M1. Okay, so basically, if you're going to trade using the trend following, you have to analyze the market through top-down analysis. You're going to look first at the higher time frame, then to the lower time frame. And then if the overall direction is the same, and then the last candle is the same, then you can place your trade confidently. Okay, so there should be an alignment of the three time frames with regards to the market structure and also the last candle before you're going to place the trade. Okay, so I hope that you learned something for the part of the trend following. Thank you very much, and I hope that this will be another learning curve on your part. Good day. Thank you.